Okay, hello everyone. All right, so um I briefly covered this last week and the Forex factory calendar. I'm going to just uh breeze through this because I'll get to it in a second. All right, let me just go ahead and share my screen so that you guys can see what I see. We'll just scroll through, skim through the Forex factory calendar. All right, so yesterday we had a lovely joint statement, not only from our Fed, but the Canadian Fed and the central bank. And instead of me just naming all of them, how about I just say that it was every major banking center in the world that we look at all came together and put out this lovely statement about the world and what's going on in the banking system. So I'm going to come back to that. Today, Christine Lagarde spoke, wasn't too far-fetched. I mean, a lot of follow-ups to yesterday. Tomorrow, German economic climate or sentiment comes out. We have CPI news from Canada. We have another speech from Christine Lagarde. Existing home sales for the United States. Wednesday, if you choose to be in the market this week, tomorrow should be your very last day. This is a short week. On Wednesday day, which is our Fed day, which is when we get our new rate. So this all kind of goes back to the conversation of what happened yesterday. So I'm going to skip it for now. A lot of the news that comes out on Thursday pertains to Sunday, so I'm going to skip it. Except for the US has unemployment claims. This news, please remember that this news is red. If you are avid with looking at economic news, you know that for the United States, this tends to be fairly moderate news, but this is very, very high impact news this week. So do not ignore this news. And we have new home sales. And then Friday, we have a ton of flash services, manufacturing news coming out for pretty much every currency that we look at. Canada has retail sales news coming out. The United States has durable goods news coming out. So Friday is going to be just working backwards towards the more important stuff now. Friday is going to be the day where we look at more long-term features within the market for the United States. So we'll be looking at flash, manufacturing and services news, and then also durable goods orders. Those should line up relatively similarly for the last month to quarter or so. Same news for Europe. All right, so going back to Thursday and Wednesday, all of these news items about rates. So take you all the way back to the middle of 2022 when the Fed stated that, they were talking more about their plan in detail, where rates to be, where they foresaw rates. We actually heard a lot of this in 2021 when they put out the initial plan. However, sometimes it takes a little bit of time for rates to adjust, markets to adjust, not only in the private sector, but public sector, banking, consumerism, Like all these different areas of the economy that we look at, they function at different paces, and it takes different amounts of time for them to actually start to realize and actually feel the full effect of these rate changes. So we get all this rate news that's going to be coming out Wednesday and Thursday. Now it's going to be more important than ever to know about these rates, how far rates are going to go up, and what the intentions of rates are going to be because of everything that's been happening in banking. So I've gone over this last week on the Zoom calls. I'm going to go over it one more time. So if you are listening to this live or you're listening to this in the future, and you just want more like detail, you can go back and look at other calls. But I'm just going to kind of summarize it for you now. Assets, smart banks. I'm not talking about smart money. I'm talking about legit smart banking institutions. When they are trying to leverage liabilities on their books, you have to find a way to exchange and make your liabilities assets. People put money into your bank, it's a liability. Why? Because that person is expecting something in return for their money, and because you're also holding their money. So now you have to find something to do with that money to make it an asset. So now you can fractionalize it. You can make loans that you can now make a spread on. You can make a profit on that. You can also shave part of that profit, pay an interest rate to the customer. Win, win, win situation. Now, you have to leverage debts that you have on your book that you have made assets, because technically, even though they're in the asset column to offset deposits, you have to now make the loans true assets in a way. So you have to kind of balance your book in multiple ways. That's why they have risk officers that work at banks. It is their job to make sure that the risk loans that may not get paid back are offset by something else on the books. And it's also their job to make sure that the customer base that they have stays and they don't take out deposits, because when you take out deposits, it throws off your asset and liability column. And now you're more, I don't want to say desperate, but now you're looking towards these loans that you wrote based on deposits. And you now know that, okay, well, once these loans are repaid, I can't write more loans because I don't have the deposits to help justify. But smart banks will go through and leverage risk. They will leverage this risk with buying something that is very long-term and stable, something that the government issues. They'll go through and get treasuries. They'll go through and get bonds. Whatever name you decide to call whatever it is that a bank decides to get and hold long-term with some sort of fixed interest rate, that's what they go get. Bonds in this instance are gotten, and the intent with bonds is to hold them, you know, for a moderate term. You don't want to hold them forever, just because banking is not really how that works. The banking system works in cycles, and they tend to work off of more moderate cycles instead of long-term cycles because of interest rates. Well, whenever you have to now adjust your books, and whenever you have the Fed changing interest rates that all coupon rate, the rate or the value of your bonds, that shouldn't bother people, even if you have them yourself. Shouldn't bother you until you need to cash it out, until you need that money, because it's like an unrealized type thing until you realize it. And anytime you realize an asset is like when you're exchanging it for something else, and it has to have a value attached to it. So that was the problem. Now, I said interest rates for a reason because that is the news we're talking about here on the Forex Factory calendar. That is a very simplified, dumbed down way of explaining kind of sort of this whole catastrophe in banking and how we ended up where we are now. And um, interest rates are going to matter because as interest rates continue to go up, there are assets on bank books that if they have to be actualized or realized, then they might have a decrease in value. So you have to also assess banking risk, not just for um, the metrics that the Fed uses to do stress tests. You also have to kind of now use add this in as a new metric. So over the past weekend, the reason why we had this whole joint come together, let's put the minds of all heads of the central banks around the world together type thing is just because um, if you've looked into Swiss banking, um, the Swiss for a long time have been known as a safe haven for the Swiss franc, the currency itself. And the banking system has been known to be a place where people put their money. Values are great. Don't have to worry about fluctuations in values of your money. The banking system has also had its fair share of troubles because of this, laundering money and so on and so forth. Um, so in the Swiss banking system, as with every banking system, you have all the little banks, but then you have your major banks. You have UBS, and you have Credit Suisse. Well, Credit Suisse is typically when you're talking about Swiss banks in the news, you hear about Swiss banks in the news, it's going to be one of the more premier banks that you hear talked about. UBS is talked about as well, but everyone talks about Credit Suisse because they do credit ratings. They speak out about a lot of stocks. They speak out about quite a few things. So you hear them more in the media here anyway. So yeah, there was a little bit of discussion about their assets, who was going to take over their assets, if some of the assets could be pinched off here, purchased by one bank, others purchased by another. Well, um, they didn't want their rival in their books, but that's what it essentially came down to, like $3.2 billion and some change of just conversions that had to be done. A lot of people are looking at this and they see this as very fractionalized, very individualized banking mishaps that are happening. However, if you really start to go back, and I mean like go like way back, I'm not going to bother you and trouble you with the long rabbit hole that I sent Mr. Levels down yesterday trying to explain this. But this involves quite a few things and quite a few people. And if you want to read the book, it's like 2 volumes and like 1,500 pages. I'll put the link in the chat for you guys, in the actual group chat for you to read it. But anyway, so this whole thing with like FTX, a lot of people don't think that that matters a whole lot. It does. That matters a lot with this whole situation, especially with Silvergate and with some of the other banking entities that had crypto holdings and moderate crypto holdings. It matters a little bit when it comes down to SVB in a very mild to moderate sort of way. And then also with what's going on now in Switzerland, you would think that it would be more isolated, but because their banking system for the longest time has been so stable, it really took not interest rate things happening and um like pop-up fires happening around the world. This was more, this is a um I'm really trying to give you guys the condensed version without explaining a whole lot. Um this is like the let's bully the rich people for a little while type thing. And a lot of people don't, they won't say it this way. This is how it's happening because when you think about all the banks and all the entities that were affected, these were people pulling deposits because they had no other way. That was all their money. That was where they put it. Um, and they want to actually have the realized value of their money without worrying about the uninsured portion being lost. So these were corporations, these were startups, most of them startups, um, other banks, venture capitalists, angels. So when you think about where those groups of people tend to put their money, you can actually look at like there are actual places where you can kind of track where they put their money. Tends to be California, New York, Florida. Fourth is Texas. They don't always make the list just because the amount that people put into Texas isn't quite as much. But to me, if it's double digits, it's considerate and it's a considerable amount and it matters. So when the Fed comes together with all these other leaders around the world, literally the whole conversation is about, okay, what do we, so don't be surprised, and you won't even have to really listen to each of their speeches because they're all going to sound alike for at least the next 4 months. I say the next months because the Fed, we have something now. We have another major meeting in May, one in June, one in August and September. So we have quite a few times to hear from the Fed, whether it's just the minutes or if it's an actual speech between now and then. And it's not going to surprise me if when you hear Christine Lagarde speak tomorrow, and if you listen to her speak today, how it's going to sound a lot like how Jerome Powell is going to sound on Wednesday. So all of these people pulling money, all of the people like moving money around, shifting money around, putting money into different markets, it's all the same people. How do I know? Because you can look at the volume. You can look at the volume and you can look at the amounts and you can see this is not just retail. Retail would happen in a lot of little incremental trades, but it would all total up to be a big amount. People who have lots of money, it would end up being fewer transactions, fewer amounts when it comes to trade volume itself, but the amount, the dollar amount attached to all those trades is going to be a lot larger. So you can typically tell what type of transactions are being done. You can also tell who just by looking at some of those things. Does it always equate and tend to fall in line with that? Not always, but 95% of the time. That's what it ends up being like. So the biggest part of our week this week is going to be Wednesday and Thursday. Literally, when starting actually today, because there has been speculation coming off of the weekend, coming off of the Credit Suisse and UBS news about what rates are going to be like, because the Fed has a narrow window now, is what you would hope they would work within. to say, okay, we still have to combat inflation. However, we have this issue, this now becoming a systemic issue, systemic because it's not just localized to one area, one state, one region anymore. It's now spread to a whole new market, whole nother country. And so now you have this risk on the table where we can't increase rates too much, but we have to still do it. So now by how much do we increase rates? Or they could say, well, do we increase rates at all? A lot of people would think that that would be a good idea, to just not increase rates at all. Let all of the rate increases kind of settle, let the market adjust to all of them. We know that's not how the Fed works. The Fed has told us in previous Fed meetings that they were going to essentially push the economy into overdrive until what they're doing, like, it's like driving a car. The light comes on and you say, I'm going to push it, and you push it, and then the car just stops working, kind of like that. Like kind of pushing the economy to the brink. Is this the brink? No one can really say, because you do have economists on both sides saying jobs aren't that bad. The economy really isn't that bad. The only thing we're dealing with right now is inflation. I don't think that's true, because when you look at the economy, when you look at jobs, when you look at everything that we have going on, like you can pick a sector and you can find things that are wrong. You can find things that are very reminiscent of 2019 in the market right now. Everybody will say, well, or you have some people that would say, well, what's wrong with 2019? Well, we had been on a kick of rate increases for a while, and the Fed had actually hinted at like tapering things. Anytime you start talking about tapering, like people get afraid. Like, yes, the markets get happy because you're um you're lowering rates. It makes for slightly cheaper money, but the effect of kind of reversing and going against what you had been doing before the problem is actually fixed a lot of times makes the problem worse. It didn't help that the Fed was trying to make corrections and adjustments in the marketplace right when COVID was happening. And then COVID just pushed everything off the cliff. So now here we are in the exact same position that we were in 2019. It's almost like, imagine if COVID never happened. Imagine if everything between now and go back to like October of 2019 never happened. Like, it's literally like we picked up from there, because now we're in a position where the economy, if you look at all the metrics, we've been in a recession. If you look at jobs, if you look at unemployment, if you look at wages, if you look at economic growth, if you look at sector growth, if you look at raw materials and conversions, if you look at cost, if you look at all those things, like all those things are completely off. All those things would lead you to say that in the next few months or so, we would have been in a recession had the Fed not, like, minus everything else going on, recession. All right. So now add on to the fact that we have really bad inflation. And here's the thing with inflation is our Fed and the Bureau of Labor Statistics have every right to, every time they get ready to go in and put out a CPI number or a core PCE number, that they could adjust the metrics for how they measure inflation. So when you go through and look at the reports and you look at, see, okay, well, this is what they use to measure inflation this time. Well, when you go back to the last report, they might not have used that same metric because they try to keep inflation within a very, very tight window. Like if you actually measured inflation based off metrics they initially used, and if they never changed it, inflation would be up well over like 50% right now. Don't, because there are social systems that they have to pay out money for that are based on the rate of inflation. There are also treasuries, bonds, and all these other stable, quote unquote, stable assets that they pay out rates for that are in accordance to the rate of inflation. And then you also, they account for rate of growth, all those types of things. So when you look at how they measure inflation, it's completely different. So when I hear the Fed talk on Wednesday, I really want to hear, I don't care about now. Now is happening. What's going on now with the banking system? We're in the midst of it. Like, okay, fine. But I want to hear, I don't even care about June either. Like, I want to know what the Fed wants to do with rates beyond the next quarter. And I say beyond the next quarter because this will put us into the mindset of how the Fed is really going to be thinking, because we would have entered the political season for the next presidential race, budget talks, you know, going into the fourth quarter of the year, ending the third quarter is always a rough part of the year. So is the Fed going to be real? Is the Fed going to be real in talking about where we've been and where we're going? Because if the Fed gets up there and they say, oh, well, you know, this is transitory. This is a this isn't a systemic issue. This is just, you know, a lack of confidence in the banking system. But we're okay now. Not really. That would actually make me feel the complete opposite. Because this isn't a solved thing. We've had some of the largest banks in the world now having to take on assets from troubled banks. And then we had well-known banks in a well-known stable, if I don't know what stable is anymore, banking system that's now, you know, just got bought out. So things, the banking system aren't as they seem. You really now have to go through and do a lot of digging to try to get some of the answers you want. Put forth a lot of effort into trying to make sure that you're doing your due diligence now to try to make the best trades that you can. Yes, it's great if you can just look at your chart, you know, think about in general news that is going on and just say, okay, well, this is what I think. And then based on a particular level or potential target that what I'm trying to say is nothing's for certain. So if you open up your chart and you think the market's going to be bullish because there's a target that's like so close and the market can't help but to get there, just remember that we are in a political and economic climate where anything can happen, anything goes, and everything that's happened as far as this banking situation, it's not over. I don't foresee it being over for a little while, just because there are other banks out there that have really bad assets on their books, and they're just holding on. The one thing, if anything, you and the Fed and everybody else should have learned from 08, 2011, 2016, 2019, this whole COVID thing, and now is the fact that if it's struggling, let it go. Because stringing these bad companies and bad banks along for so long and allowing them to get so bad and get entangled with like good banks and other good systems has now just kind of poisoned the system. And now you're going to have to go through and just like cut out parts of the system in order to make the system whole again. And that's going to potentially affect some consumers, not in a major way, like, people might see like, oh, a loan, like from Santander, for instance. Santander, for me, in my mind, is a very risky bank. Um, like if you have a loan with Santander, it'd be nothing if Santander, something happens to them, and then you end up having your loan being transferred over to another institution. Like those types of things, and then having to deal with the new institution and what they could possibly do. And it's just those types of things you have to think about. But anyway, tomorrow is the day Trump thinks he's going to be arrested. So uprisings and protests tomorrow. It's pre-Fed day tomorrow. Also, they're looking to snatch money out of JP Morgan over Epstein. If you don't know the whole Epstein story, other than kids, you've really done yourself a disservice, because you really have to like dig in and like really look at who he was before people just brought kids into the matter or into the mix. Um, anyway, whatever. I'm gonna go ahead and turn it over to Mr. Levels, because you guys don't need a rabbit hole on Monday, and let him get started with the technicals for the week.
Cool beans. Yeah, definitely do your definitely do your research on Epstein, because Corman on she definitely blew my mind yesterday with the rabbit hole. With the rabbit hole she took me down. So yeah, it gets deep. It gets deep. So yeah, let's jump into these weekly tech technicals, guys. All right. Internet don't start messing up on me now. Cool beans. Jumping into the beginning of the week technicals. Looking at the dollar as always. We see coming in from last week, leaving off from last Friday. I told you guys that we would want to see how price action opened up for the new trading week, reacting to this PD array here, this discount array. We wanted to see if we open up the week closing below that discount array. Um, we wanted to see if we opened up the week pushing below the discount array, and what kind of um, volatility we was pushing um, below. So we wanted to see an aggressive break below the discount array. And I told you guys if we got that we would be expecting price to run sell side liquidity. That's what we got. If we go down to the daily, I'm sorry, the hour, um, we see we seen price give us that push that we wanted to see. We see nice size bearish candles pushing to the way, pushing down to the sell side liquidity. And so now this is what I'm looking for. I'm looking to see from here throughout the rest of Asia and going into London tonight. I'm looking to see how price action behaves. I want to see if price action, first of all, gets back above the sell side liquidity that we ran, that we just ran. And if we get above that, then of course we'll be looking for the algorithm to deliver price up into this city, sell side imbalance, buy side inefficiency, and as well as fair value gap. Um, and then we will look and see how price reacts to that. If we respect this fair value gap on the dollar and we do not break back above the discount array, then I will be expecting the dollar to come down into the daily fair value gap that you see here. However, if we break above sell side liquidity and push through the fair value gap and we get back above the PD array, then I'm going to be targeting first these fairly equal highs along with this fair value gap. And if we respect this breaker block here, low, high, lower, low, then we will be, once we take these highs and come up into this fair value gap and we pull back down to this, if we pull back to it, we just don't explode straight through the fair value gap in the new week open, then we should pull back down to the breaker block. And once we do that, then I will be looking to long to push back up into the new week opening gap and possibly um, to fry this PD array again to run buy side liquidity. So that's what we'll be looking for out of the dollar to start the week with. Um, yeah, so I will clean my charts up and drop my new analysis in the Telegram group. I've already started to chart EU, so we see today's buy side liquidity. Um, Here, sell side liquidity here, discount array. As I told you, you should mark every day just like this. So tomorrow, well, first, depending on what price action gives us throughout the rest of Asian markets and going into London tonight, right? I'm going to be paying attention to price action. I want to see us pull back down into this discount array. And as you know, the dollar is inversely correlated. I'm sorry, as you know, Euro USD is inversely correlated with DSY. So if we're expecting or wanting to see the dollar push down into that daily fair value gap, then we would be wanting Euro USD to push up. And so we may see a correction throughout the rest of tonight going into London. Hopefully, well, if so, not hopefully, but if so, if we get that pull back down into the discount array, that is a breaker block sitting right on top of that discount array too. I just not seeing low, high, lower, low, low, high, lower, low, low, high, lower, low, break through it right there, broke through the high. That gives you your breaker block inside of a discount array. So yeah, that's beautiful. So we'll see if we get that throughout the rest of Asian and going into London. And of course, we will be targeting, as I said, this buy side liquidity, and this buy side liquidity here. That's what we'll be expecting out of Euro USD and the other currencies as well. So I'm only going to look at Euro USD because GBP USD and NZD, they both pretty much correlate with Euro USD. So you mark your daily candles up on them the same way you mark it up on USD and stick to the street. Looking at silver. All right, so if the dollar continues to push down, then we're gonna expect silver to continue to push on up into this CB, aka fair value gap, um, to run that, possibly retest market structure, and we'll see what happens when we get there. Let me see how price play out throughout the rest of Asia. I'm looking at this fair value gap on the daily. You could see silver come back down into that sweep up to the other side. So be aware of that. Same thing with gold. Um, Next level that I ain't been paying attention to gold like that. Honestly, I didn't even know we had broke back above. Yeah, we broke above 2,000. What happened to my level I had? I had a level right there, I thought. I know I had a level at 2,000 because that's the level we've been waiting on. Um, oh, I got my stuff. Okay, I'm tripping. All right. Um, yeah, I had it at 1998. So we hit the level. So of course we're going to see some kind of reaction to that level, and that's what we're seeing now. Um, the correction off of that push up off of 1819 down here. So yeah. Looking for the break block. Ish. Um, we just gonna put that right. Yeah, 'cause hmm, all right, so we'll use this as a breaking block. I see low, high, low, low. So yeah. Um, and it looked like the breaker block might be consequent encroachment of this fair value gap. That would be definitely be dope. Let me see some measure it. You guys know that consequent encroachment is 50% of a gap or a wick long, overextended wick. Consequent encroachment would be 50%. If 50%. Oh, let me see. But now it's down there in the PD array area, though. Let me see something. Internet's starting to act crazy, y'all. You ain't doing good, girl. I'm doing. Yeah, she around now. She, yeah, Yeah, that's good, man. Yeah. That's if gold just don't fly away. We've already taken 2000. So next level is, I'm gonna keep that right there. Refer to that for 2071. 2007 and 42. I need that. All right, perfect. Yeah. So we shall see. So let's look at the dollar right quick. Hmm. Yeah, gold might be about to fly. You may not even see a retest of the discount rate, but we'll see. Patience is a virtue. Um, oil. I told you guys, let's see if we pull back up into the fair value gap that we deep up, and we'll see how all reacts to that price. Um, as y'all know, my long term analysis for all is 129. I want to see us reach back up there, but I don't know what's going on with all right now. Um, and let Carmen dig in her bag and advise me on that, and then I'll take that into consideration. And um I may start looking for opportunities to the short side if she says that's viable. So we'll see. Um, moving on to futures. I haven't started marking up futures yet, y'all. So hold on. Did I did. I just marked the new week opening gap, which is what we see right here. We see price open up gap to the upside for the new trading week, and then we did not run last week's highs when we gapped up before we started to sell off. So that's an indication that we was gonna run um, last week lows or sell side liquidity, right? Because we failed to run buy side liquidity when the market opened up. You can see we open here for S&P 500 E-mini futures, but we did not run a previous buy side liquidity. So we see price action breakdown right here. Here again, breaking below the upper level of the newly opening gap. So that was giving us strong indication that we was going to see price run this sell side liquidity. Um, and so we got the run of that sell side liquidity, and then price came back up into um, this Friday. That fair value gap that you see I have identified here, we came back up into that to close out today. And if you break down to the 5 minute time frame, you will see my market maker buyer model, which is run on liquidity, turtle soup, which is the lower low, after the run of a higher time frame liquidity. What we see we had here, if we go back to the daily time frame, we see we had a higher time frame sell side liquidity rant right there. So go back to the 5 minute. So we see sell side liquidity rant. We see turtle soup, right, which is the lower low after sell side liquidity has been ran in a higher time frame. Then we look for breakaway gaps. You see a breakaway gap right here. We look for break of market structure. You see the break of market structure, or as Michael Huddleston calls it, market structure shift. I like using my own language. That way I don't have to infringe on his rights. Um, and that way I don't have to keep giving him credit every time I say use his IP. So market, I call this market structure break, but market structure shift, as Michael Huddleston calls it. We see the break of that market structure or the market structure shift within that fair value gap. And then we see the breaker block form. What is the breaker block? Low, high, lower, low. What is the breaker block? Low, high, lower, low. What is the breaker block? Low, high, lower, low. So this is my market maker buyer model. This is my bread and butter. And so once you see that run of liquidity on a higher time frame, we see that turtle soup, which is that lower low after the run of liquidity on a higher time frame. We look for a breakaway gap, which is a grail confluence. You don't get the breakaway gap every single time in the market maker buyer model, but when you do that, that's extra strong confluence in your favor. So we see the breakaway gap. We see the market structure shift, or what I call the market structure break. We see the breaker block form. Those are the confluences that I'm looking for to run this bullish move up to buy side liquidity. And where will buy side liquidity be from here? Uh, from here, right? Because we're taking this entry off of what? The breaker block. So we see price pull back down, retest the top of our breaker block, that high, the high of the breaker block, the low, the high, and the lower low. That's our entry. We're running. When we know the motto, the mentor says 5 handles. That's 5 handles there. Um, so I mean, this trade should have played out fairly fast if anybody was using the market maker buyer model today. So yeah, this was a run today. Could have easily. I didn't trade today. I probably wouldn't be trading until tomorrow if I trade this week here. But yeah, 64 handles, 258 ticks. So yeah, entering from right here. If I'd have been in this trade, um, I would have been targeting this first, the lower level of this new week opening gap. I would have took profits there. I would have took partials there. The top of that level of the new week's opening gap, I would have took profits there. And if I would have took partials there, and if I still had something left over on the trade, then I would have allowed that to run. I would have, of course, moved my stop loss to BE right here off of the entry, right? Because off of this entry, the stop loss is going to be like right here, below that low. Yeah, my stop loss would be right here, below the fair value gap, right? Below the fair value, right? And yeah, so once I took those two partials here and here, I would have took and moved that stop loss to break even. Um, and I would have let the remainder contract or contracts run up into the daily fair value gap. I mean, I'm sorry. Was that the hour fair value gap? Yeah, the hourly fair value gap right there. And that'll be in a beautiful trade for today. Um, so moving forward for E-mini, I want to see if we pull back. Yeah, we already ran yesterday's. Um, yeah, let me see. Daily fair value gap up here, right? Okay. Mhm. Oh yeah. Well, this is our next outside liquidity. We've already ran that value gap. All right. Mhm. Yeah, we got it back closer. So yeah, let's see if we pull back down into this new opening gap and how price action reacts to that. If we can't get back down, if we can't break this market structure here, then we're probably just gonna go ahead and run up more than likely and run this buy side liquidity and see where we go from there. Um, but I would like to see us come down and retest the top of this new opening gap um, before we swing up to take that buy side liquidity. So that's what I'm expecting out of futures. That's um, E-minis and Dow. My internet will catch up with me. Yeah, same thing for Dow. NASDAQ. Ugly. I don't even want to look at NASDAQ. So moving on to crypto. Um, Bitty. Bitty still pushing strong. Y'all know the next level. I ain't gotta say it. Big round figure number, 30,000. To be exact, 29,902 is my level. So let's let's see. If we come back down to 25,200, y'all know we will dollar cost average in from there. Of course, after we see how price react to the level, of course, if it comes down and it blows straight through, we're not going to start buying Satoshi. But if it respects the level and it starts showing signs and unwillingness to go lower, then we will DCAN up to 30,000. Same thing for Ethereum. Ethereum look like we're gonna go ahead and pull that down. Definitely go to test this market structure. Be aware of that. Still got this fair value gap here that we never filled in. That's down there though on the daily time. But we still could come down to here, 1,500. So just be aware of that. And eight, eight still ain't gave me no push up. So we just gonna see with eight. Eight may come back down. We already, let's see. Eight may come back down. Let's see if we get back above this market structure. If we can't get back above here, then we're definitely coming back down to retest this market structure. Maybe we got some unfinished business down here, some more liquidity to come down here and scoop up. So we did, as a matter, we didn't run the sell side liquidity. We only filled in the fair value gap. So the algorithm may be delivering price back down to $3.25 to run this sell side liquidity before we see eight take off. So that'll bring my beginning of the week technical analysis to an end. At this time, I'll stop sharing and stop my recording and take any questions.